Hi, this is Tim Berkwin, host of TraderInterviews.com. This is a recent interview we did with a successful trader. More detailed interviews can be found in the interviews section of the website. While you're listening, click on the premium tab at the top of TraderInterviews.com to find out more. Thanks for taking a look and enjoy this behind-the-scenes look at how one trader makes a great living in the markets. Hello, everybody, and welcome back to TraderInterviews.com. Thanks for joining us for another episode this week. We're going to be speaking with Tim Knight. He is the founder of Profit.net. Most of you, I'm sure, have heard of that company and that website. He's also got a blog called The Slope of Hope. We're going to ask him about that and what that means, actually. And then, of course, he's got a book that many of you have heard of called Chart Your Way to Profits. And we're going to talk to him about some technical analysis tools that maybe we can think about using in our own trading as well. So, Tim, thanks very much for joining us on the phone today.
Thank you. My pleasure.
Well, first of all, what does Slope of Hope mean? Why did you name your blog that?
Well, there's an old saying I'm sure you've heard and a lot of your listeners have heard, which is that markets climb a wall of worry and slide down a slope of hope. And my blog and my disposition tend to be pretty bearish, so I thought that would be a apropos name for it. So that's what it's all about. The general notion being that in bear markets, that the vast majority of people are simply hoping things will turn around. And on my blog, we try to profit from the slides. So that's what it's all about.
So there's a lot of talk right now, specifically in the markets, and we don't go too much into real-timely things because this will be on the site for a long time. But
Sure.
There was a big argument about whether or not this is a new bull market or some sort of bear market rally that now we're seeing maybe the end of. What are your thoughts?
Well, I'm pretty heavily into the retracement camp. I have been a little premature in the bear market back in early 2007, but when it finally kicked in, things started getting really interesting for me and my readers. And one thing I want to correct myself on as far as slope goes is that it's not entirely bearish. In the kind of mid-March to mid-June rally, we did a lot of long plays, which did well, but it was all kind of cognizant of the notion that this was a counter-trend rally. And as we sit here today, really where I'm on the fence isn't whether it's a bull market or a retracement. It's more, is this it? Are we going to fall from here? Or is there more to go and then we'll fall? And I'm actually in the latter camp. I actually do think that the market might somehow squeeze out some more gains before we get the real tumble rolling again.
Do you look at long-term charts that go out years to kind of get a feel for the market, or are you pretty short-term?
You know, it's funny. My trading is quite short-term. My positions I'm usually holding measured in maybe a couple of days up to a couple of weeks. But the strange thing is the charts I look at tend to be 10 years long. I really like to, particularly on the short side, look for charts which are really mashed up against meaningful resistance or just are so lofty that I think the risk-reward ratio is really appealing. Because I'd like, if a fall does start, I'd like lots and lots of open air through which the prices can fall.
And when you do short-term trade, what kind of time frames are you looking at then?
Well, you know, it's sort of a function of the size of the position and my confidence in it. So, for example, I tend to be a very simple options trader. I don't write options or anything like that. I simply just buy them, typically puts, and those, in spite of being derivatives, tend to be my longest holding period. So I might hang on to those for any number of weeks and even a month or two. Whereas if I'm looking at a big ETF position, like GLD for gold or USO for crude oil, things like that, those might be very large cash positions, but span maybe just 1, 2, 3 days, something like that. I'm looking for big directional moves and kind of get in and get out quickly.
During that period last year when we had a ton of volatility, options seem to be so expensive. Have they gotten cheaper? Do you find yourself being able to make better decisions now?
Yeah, I tend to be kind of conservative in terms of the options I buy. They tend to be rather far out. They tend to be 3 months or more out, and they also tend to be fairly deeply in the money. Normally, the intrinsic value is about 80% plus on the options I'm buying. So I'm not looking for hit them out of the ballpark, 2,000% gains. And as far as the comparison between last autumn, when the VIX was, threatening getting into the triple digits, and right now, when we actually dip beneath 30 again, it's definitely a lot more of a sane time to get in there and take the risk. So I've been definitely buying a lot more puts lately, whereas I really shied away from them when they were just absolutely bananas back last year.
3 months out, something that's deep into the money, how are you determining which front month or which strike price you're typically going to buy?
Yeah. Well, as long as I've been trading and as actively as I trade, I think people would be shocked and maybe even disappointed at how unscientific my approach is. I really, I'm surprised when people buy things that are going to expire in a week or two. I mean, you need to give yourself some amount of latitude. And so what I'm normally looking at, as I said earlier, is like an intrinsic value of at least 80%. And typically I really like options whose underlying stock is somewhat high in price. And by that I mean things like BIDU or Google or CME, based on the simple fact that the opportunity for the underlying price to fall 30 or 40 or 50 points is present. Now, clearly that prospect and that volatility is built into the price, but the fact of the matter is that if you've got a bunch of puts on, say, General Electric, which is an $11 stock, versus Google, which is $450 stock, the percentage opportunity is much greater with the the larger price issues. So those I find more appealing.
Yeah, I think a lot of traders, I know I do, whenever I see those cheaper options that are maybe the next month out or right at the strike price or maybe a little out of the money, they look so darn cheap, I think, well, might as well because they're so cheap, and yet inevitably you'll probably lose all of it in time value, I guess, over a couple of weeks. It's probably worth spending more money, I guess.
Yeah. I mean, you've seen those time decay curves, I'm sure, and once you're into the expiration month, it's just a boulder falling off a mountain. It just really gets wasted very quickly, and that's not what we're trying to do. We just want to make good, healthy profits, and if I can turn 50 to 100% on an option trade, I'm a happy guy.
Sure, I think anybody would be, absolutely. Well, now, you've got a ton of pattern setups and chart setups in your book. Do you use some of those in options as well as equities or other markets as well?
Right. Well, sometimes people ask if they should chart options themselves, and I don't think so, and I never do. I think that the volume and the volatility is just completely inappropriate for a chart. But of course, in this day and age, now that we have contingent orders, it's very nice to be able to have an option position and then place an order based on the underlying stock, so that you have that kind of level of elegance to managing the position. As far as the patterns that I like, I definitely have some favorites. They tend to be kind of tried and true, simple ones. Head and Shoulders is definitely a favorite of mine as far as bear markets, and a nice big dome pattern. The longer and cleaner the pattern is, the more appealing it is. And of course, favorite thing of all for me on either the short or the long side is that after a price move has been made away from a given pattern, be it a cup with handle or any sort of saucer pattern or Head and Shoulders, as I mentioned before, once that break has taken place and it retraces back to the breakaway level, that's my favorite kind of trade, because you've sort of got the best of both worlds. A, the opportunity has been spelled out for you, and B, you've really cut your risk because you're entering at a much more attractive price point. Mm-hmm. So if you think back to September 19, I think it was, of 2008, when there was all that surprise news from kind of the Fed riding to the rescue, and the market wasn't used to such things quite yet, there was this tremendous push higher, which at the time I remember sending out a notification to my readers that this is the shorting opportunity of a lifetime, because basically all these wonderful opportunities were handed to the market to the bears on a silver platter because of this big push up to those broken necklines, and it was a beautiful time